All right. Welcome, everybody. Thank you guys for coming on a Sunday. My name's Joe Malika from Gotham Sound. I know this is 11 o'clock on a Sunday morning, what everybody really wanted to do, so thanks for coming out. I first want to say thanks to the Frank Sinatra High School who donated this space for us. We got over 400 RSVPs on the Eventbrite, so we went, that's not going to fit in our shop right one block away. So they were, generous enough. As you can see, this beautiful set is for Ragtime. I think that's coming up in 2 weeks. Check it out. I wanted to thank the entire Gotham Sound team who came out today, volunteered their Sunday as well to do this for us and for you guys. Francesca from our sales department is going to be on a camera. David Newman from our shipping department on a camera. We've got Max from sales on sound. Jared, our marketing team, is on live stream. We got Jason, Melissa, Peter, who am I forgetting? Nico. That everybody? Oh, and Adam Goodman. Can't forget you. So we're all doing things that we don't normally do, so this is fun for us and a little bit nerve-wracking for everybody as well. Also wanted to thank Iba, who's here from the school helping us out. One shameless plug on May 5th, the Gotham Expo. That's really for anybody, not just sound, but if you have any interest in sound, you're doing it like a one-man band. Anybody that's new to sound, wants to know more about sound, all the way to somebody who's been doing it for 20 years, check it out at our shop. All the vendors that do sound will be there just to kind of show off their gear and get it from the people that actually manufacture the equipment and cables and mixers, recorders, mics. So now I want to introduce Nancy Adams and Debbie Hammett. This is Nancy, this is Debbie. They're going to take you through the next hour and a half of kind of a overview of 2017 and the new 2018 taxes. A lot of changes are going to happen, but you're still on the old stuff now, so they will guide you through that. We want to keep the questions in the first part to a minimum, let them get through everything, because they might be getting to it later in their presentation. Does anybody not have one of the presentations or a pen? Everybody has one. That's awesome. Write down your questions on that. There's some blank spots in the back. And then we'll take a short break. We'll come back and do a Q&A. We'll have mics on either side of the stage for you guys to go up to and ask any questions that you might have. This is also being live streamed on our live stream account, so people that couldn't make it here today because the trains are terrible will be able to ask some questions there. So we want to make sure people get to a microphone when they ask questions so that people on the internet can also hear those as well. So without any further ado, take it over.
That's great. Hi, I'm Nancy. I'm really glad to be here. I just moved to Santa Fe in December. I've worked in New York for about 30 years. I still come back to New York about once a month, which is why I'm here, and see clients and do things like that. But Santa Fe is lovely this time of year. I have to say it's a lot warmer than it has been here. The second page just gives you a little bit about our background, that I've been doing this for a while, and so has Debbie. We're not going to mention any ages. So our objectives here really are to discuss the basis of tax deductions. Why do you get to deduct anything anyway? To look at the rules that are in effect for 2017 and how that's going to be changing and compare it to 2018, and to talk a little bit about some planning opportunities for 2018. It's not too late to change how you're doing things. It's not intended, the presentation's really not intended to be a complete overview of the new tax law. There's just not enough time for us to really go through everything, but we're going to hit the things that we think are most relevant to you and most important to you. So why do you get to deduct tax deductions anyway? So the basic rule is that the Internal Revenue Code section 162 says people who are engaged in a trade or business are allowed to deduct expenses that are ordinary and necessary. Well, there are a couple of complicating factors to that, because first of all, the code doesn't define what is a trade or business. It's been defined through common law, really, to say anyone engaged in an activity that is carried on for profit or as one's livelihood. So the profit making is the key thing that the Internal Revenue Service looks at to say, is this really a business or not? I'm sure that all of you have heard of the hobby loss rules, and we can talk about that a little bit more a little later. So, trader business, you're carrying that on as your livelihood. So what's ordinary and necessary? Well, like everything in the Internal Revenue Code, it depends on the facts and circumstances. There's no clear definition of that as well. Something that is ordinary is regularly incurred by people in this profession. Necessary, it's required for you to be able to carry on your business. But again, there are no hard and fast rules. It's more what is appropriate and common to one's industry. Where do you deduct expenses? Well, that depends. That depends in part on whether you are an employee or whether you're self-employed or some combination of both. If you are an employee and you receive a W-2 from your employer, and you have unreimbursed employee business expenses, then you deduct those as an itemized deduction on Form 2106, which are called unreimbursed employee business expenses. In order to be able to deduct those, you have to meet a threshold. First of all, you have to be able to itemize deductions. In other words, the total of all your itemized deductions has to be greater than the standard deduction. And you have to meet a 2% of adjusted gross income threshold. Meaning, if, for example, you had $50,000 of adjusted gross income, you can start to deduct expenses when they exceed $1,000. So if you have $1,500 of unreimbursed employee business expenses and your income were $50,000, you would get a $500 deduction after the threshold was applied. On the other hand, if you are self-employed, then you deduct your expenses, you net those expenses directly against your income. You report your self-employment income on Schedule C, and you report the gross of your income, and you report the expenses you deduct the expenses against that, and then you pay tax on the net. You pay self-employment tax on the net, and you pay regular income tax on the net as well. Now, what happens if you get both 1099s and a W-2? The IRS says you've got to make some sort of reasonable allocation between the two activities. You can't just put all of your expenses on Schedule C if some of them are really related to your W-2 activities as well. So you make some sort of allocation between them to say, oh, this expense is related to this activity, and these expenses are related to that activity. So now we're going to talk a little bit about some specific expenses and expenses that I consider to be related to the entertainment and generally all business activities, but also related to production and activities that you guys engage in. So first, meals and entertainment. In order to be able to deduct meals and entertainment, it has to be related to one of two standards. It must be directly related to the active conduct of a trade or business, or it must be entertainment associated with the conduct of trade or business. So what does that mean? So directly related means that you are meeting with a client to discuss activities, or meeting with a potential client to discuss the possibility of getting business or conducting business with them. Entertainment associated with the conduct of trade or business is, let's say that you have a client in from out of town and you guys spend the day working together and then you go out to dinner that evening. So it's associated with, not directly related to. So what does that mean to you? It means that you have to be reasonable in the way that you deduct your expenses. So going out to dinner with friends weekly is probably not a really good deduction, but an occasional networking activity could be considered trade or business if you think that there's a possibility of generating income from that. My watchword in terms of all expenses is just don't be greedy. The IRS doesn't like it when they perceive what you deduct is greedy. In other words, taking a lot of deductions or too much deductions. It's because the IRS considers certain expenses subject to abuse, that they limit them. So, for example, on meals and entertainment, you're only limited to 50% of the total expense. But beyond that, you have a responsibility to document with whom and for what an activity was. So making some sort of notation, on your American Express statement, or making some sort of notation to say, this is who I met with, and to be able to say, we discussed X, we discussed some business. So meals and entertainment is one of the areas that the IRS looks at. For telephone, the old rule used to be, when everyone had a landline, that you couldn't deduct the basic service on the first phone because, hey, the IRS assumed that you would have a home phone anyway. So if you had a second line, then you could deduct expenses associated with that. Now, no one has a landline, or very few people have a landline. Most people only have a cell phone. And I'll tell you my experience is that the very first question the auditor asks in an IRS audit is, how much of the cell phone did you deduct? So it's important to allocate some usage to personal. Even if it's a de minimis amount, or it's like you say, oh, I allocated 25% to personal use. But it's important to allocate something to personal use because it's always the first question they ask. Gifts are limited to $25 per donee, meaning you can only deduct the first $25 of something that you spend on a business-related gift. The way to think about that is, let's say that I'm giving a gift to a client and there are 5 people at the office. So maybe if I'm giving the gift to all 5 people, maybe the gift is $125. Or maybe I'm giving it to a client and his spouse. So instead of just $25, maybe I can deduct $50. But they actually do look at this. I had a client once that I told him, do not give year-end bonuses to staff as cash without withholdings. You can only deduct it if it goes through wages. Otherwise, you're limited. Well, sure enough, he gave cash bonuses to his employees, and he was audited by the IRS. Everything was disallowed except for the first $25 per person, and he actually spent quite a lot more than that on it. Education expenses. The cost incurred in getting your basic qualification to practice in a profession is not deductible. The IRS considers that a capital investment in yourself. Any education that you obtain once you get your basic education, that becomes deductible. I like to use the example of me as a CPA. To be able to be a CPA and practice in my profession, in the old school days when I got my education, not necessarily now, but in the old days, I had to have a 4-year undergraduate degree, take an exam, and then work 2 years in the profession to be able to be licensed. So the IRS said basically the first 4 years, your undergraduate education, none of that is tax deductible. Once I obtained that degree, however, when I went on to get a master's degree, then the cost of that education was tax deductible because it wasn't necessary for me to be able to practice in my profession. So the question that you need to ask yourself is, what is the minimum qualification to be in your profession? Because once you've obtained that, then anything else you spend on educational seminars or classes would be deductible. For anyone who's talent, I always get this question, can I deduct my gym? And the answer is no, period, end of story. Unfortunately, most people don't like that answer. Auto expenses are another area where the IRS thinks that there's the potential for abuse. So you must, if you're going to be deducting auto expenses, you really need to keep track of your mileage. there's a phrase that the IRS uses, which is keep a contemporaneous record of your business usage, because they don't find your recreation of it 3 years down the road when you're being audited very compelling. So do your best to try to keep some sort of record as you go. You are permitted to either take the standard mileage rate, where you say, oh, I'm taking, in 2017, 53.5 cents per mile, which increases to 54.5 cents per mile, business mile in 2018. You can either say, you know what, I traveled 15 times to this client and it was 20 miles, so that's 300 miles, and 300 miles times 53.5 cents yields this deduction. Or you can take the actual expenses, and what you do there is you add up all of your expenses, including gas, repairs, insurance, registration for the car, and so on, and then you take a proportion of the expenses based on business mileage to total mileage. It's important to note that if you are a W-2 employee, then you're not permitted to deduct commuting to and from work. On the other hand, if you are self-employed, work begins at your house. Theoretically, you're employed as of from your front door. So any travel that you incur from your home to a client becomes deductible. So it's important to make a distinction. If you're getting W-2s and if you're getting 1099s, make a distinction between what is the mileage associated with the 1099s, because potentially that's deductible. Additionally, if you are a W-2 employee and your normal place of employment is at an office, and you need to go to a client or you need to go to a job site and you're not reimbursed by your employer, then that would be considered a deductible expense from the office to wherever the job site would be. Local transportation. As I just noted, the commutation to and from the job is not deductible. But on the other hand, if you go to travel to a job site and you're not reimbursed, then that would be deductible. Additionally, if, for example, you work late, which accountants often do during tax season, then and you take a cab home, for example, because it's so late when you get out, it's not safe for you to travel, then a safety fare home or a cab fare home would be deductible. So when is a home office deduction available? It's available if you are self-employed. If you are not self-employed, if you're a W-2 employee and you claim a home office deduction, the chances are about 9 out of 10 that you will be audited on that deduction. So it's the circumstances under which you could potentially claim it would be you have an employer that's located out of state. They've hired you to do a job in New York. They don't have office space here. That would be really the only time where an employee would be entitled to deduct a home office deduction. If, on the other hand, you're self-employed, then potentially you can deduct a home office deduction. You must meet one of two standards in order to be able to deduct a home office deduction. First, it must be your principal place of business, or you must conduct significant administrative activities there, or it's the place where you meet customers or clients in the ordinary course of business. So the home office deduction has evolved over the years, and initially the rules were very limited and very narrow, pretty strict. The rules initially said it had to be the place where you met customers or clients. And there was a court case where a doctor took it all the way to the Supreme Court. And the facts and circumstances for him were that he was a doctor in 3 different hospitals, or several different hospitals, I don't know if it was 3. But he was an anesthesiologist, and he would go to each of the hospital sites, and he would perform anesthesia on the patients who were being operated on. But he had no office in any of the hospitals. So he would then go home and do all of his administrative work and all of his billing from a dedicated space in his home where he had a separate office set up. And at the time, the rules were that it had to be the place where you met your customers or clients. So he said, hey, that's not really fair. I don't have an office. I can't conduct any of these activities. I should be able to deduct it. So it went all the way to the Supreme Court, and the Supreme Court decided against him and said, we're sorry, you make a good case, but the rules are it's got to be where you meet your customers, and you meet your customers in the hospital. So after that, the IRS said, or the Congress said, this is not really what we intended. What we intended is if you have a place in your home where you conduct significant administrative activities, then you potentially can meet the home office test. So, we don't want to punish, in particular, people like plumbers or repair people who are always going to be going out. So if you have a dedicated space in your home that's used only for conducting business, and you conduct, administrative or business or billing kinds of activities, research, then yes, you could qualify for a home office deduction. There's a test that I like to call the kitchen table test. It has to be only for the purpose of doing business, a desk. You can't, say for example, use the kitchen table for work, clean it off, and then eat dinner there later, because that's not a dedicated space. A dedicated space is used really only for that purpose. So you need to have an alcove, a desk, something in your office something in your home that would qualify as a separate space, if you will. As noted, if you're an employee, it must be for the convenience of the employer that they don't have a space for you to work in the city you're located in, so you have to conduct activities at home. I have a good friend that is a textile designer, and her company doesn't have any kind of office in New York, so she does all of her activities at home. They rent, when, for example, they're doing their market week, they rent space in New York City and show all of their textiles in that space for that week, but otherwise she always works at home. So her employer has separated out, they pay her a wage for the work that she does, but they also pay her a rental fee for the use of her space, so that she's entitled to a home office deduction for that. So certain expenses are deductible because you are away from home. I like to call this the dry cleaner rule. Expenses incurred when you are temporarily away from home on business are deductible, whereas they're not deductible when you're at home. I used to have a client that would bring in all of their dry cleaning receipts with addresses all in New York City. And I'm like, wait a minute, this is not the purpose of this rule. If you're temporarily away from home, and temporary has a definition. Temporary means that at the outset, it is intended to be less than a year. So if, for example, you're going to go for a shoot and you're coming to New Mexico, where we like to call the film industry there Tamalewood, if you're coming to Tamalewood to shoot for 3 months, and then you are going to be coming back to New York at the end of that period, then that would be considered a temporary assignment because you're expected to be away from home less than a year. If the job is expected to be more than a year, then the IRS considers that you've changed your tax home and the expenses no longer are deductible. So I had a good friend years ago that was, they promised her, she took this job because they promised her it was going to be shot on the East Coast. And then, of course, after she signed on the dotted line, they signed somebody in Hollywood so that they ended up shooting the whole thing on the West Coast. I'll just say she was not happy about that. Because it was a pilot and the whole, it was unclear whether the pilot was going to be picked up by the network or not, the expenses that she incurred in the first, say, 7 or 8 months while they were shooting the pilot, and once the pilot aired, it got picked up for a second season. So once it got picked up for a second season, then it was clear that she was going to be away from home for more than a year. So at that point, at the point at which she was no longer temporarily away from home, none of the expenses were deductible. So for the first year, she deducted all of her rent and all of the meals and all of the expenses that she incurred. But then once it got picked up, she bought a house, and fortunately the pilot paid for that. And so at that point, she was considered a resident of California. So what kinds of things are deductible? Pretty much anything. So, what I say to people is, if you know you're about to travel and you're about to go out of town, then, wait and buy your supplies when you're on the road, because those are deductible if you buy them when you're there, but they're not deductible if you buy them before you leave. When I lived in Arkansas, I used to, that's where I'm originally from, if you're wondering about the accent. We used to travel for a week at a time. We audited throughout the state. And we had one person, we would all drop our dry cleaning off on Friday night when we got home, and then try to pick it up, Monday morning before we left. She would take hers to the hotel and have her laundry done at the hotel while we were away for the week. So her dry cleaning was deductible, while none of ours was. So travel of a spouse or dependent is not deductible unless the spouse or dependent is an employee of the same organization. In other words, years ago it used to be acceptable that if you were traveling on business and you took your spouse with you, the spouse's expenses were deductible, but that is no longer true. So what types of expenses are deductible? Meals, lodging, transportation, baggage, tips, etc. Supplies, things that, dry cleaning. So I have a slide on employer expense reimbursements, and this is gonna be a little more important when it'll come into sharper focus when Debbie talks a little bit about changes in tax laws. If you are a W-2 employee and your employer agrees to reimburse you for expenses, it can take one of two forms. If your employer says, I'm going to give you a flat allowance each month. I'm going to reimburse you $100 a month to cover the use of your personal computer and your cell phone. Then that's taxable to you because they're giving you an allowance. They're not requiring you to submit receipts to them to reimburse you for a specific business percentage. If, on the other hand, your employer says, give me a receipt, I will, when you give me a receipt, I will write you a check back for the cost of your hotel. The one exception to this rule is meal per diems. Meal per diems are considered an accountable plan. So let me back up for a second. So there are two types of plans, accountable and non-accountable. Accountable plans say the employer, I submit specific expenses to the employer then writes me a check and reimburses me for those expenses. That's not considered taxable income to me. That's considered an accountable plan, and I don't get taxed on it. If, on the other hand, the employer says, I'm going to pay you a flat sum for the rental of for your equipment or your computer or your cell phone, without requiring you to provide receipts, then that is taxable to you. And again, the one exception to that is if you're traveling and they give you a meal per diem daily. That's considered part of an accountable plan. So again, once we get to some of the changes in the tax law, you'll understand why this is a little bit more important going forward. And the last thing that I wanted to touch on in this area is retirement planning. And it's simply to say that only a few expenses can be incurred after the end of the tax year and still be considered deductible in the previous year. One of those expenses are retirement plans. So you can fund a retirement plan in 2018 up to the due date of the return. And for some plans, it's the due date of the return, including extensions. you can fund those and still get a deduction on your 2017 returns. Specifically, traditional or Roth IRAs have to be funded by April 15th. That's a use it or lose it. But other types of plans, for example, a SEP IRA, a simplified employee pension, the SEP IRA, or a simple or solo 401k, I believe the solo 401k goes through the due date of the extensions, including the due dates of the returns. For the plans, retirement plans, know that there are different limits depending on the type of plan, and that some are tied to the amount of your net income, others are a fixed sum. So if you're interested in funding your retirement, then you want to definitely ask your accountant about what can I do and how can I max this out. So that concludes the portion of basic why can I deduct it, what are the rules associated with it, and now I'm going to turn it over to Debbie. We're going to swap seats just so that she can
do the slides.
She can advance her own slides.
Good afternoon. It's a pleasure to be here. I'm going to go through the old law and the new law. With the new law, one thing to note, there is no one-size-fits-all. It depends on the individual taxpayer and the facts and circumstances. I've seen cases where their tax has gone down, and I've seen cases where their tax has gone up. Especially when you bring into where if it depends on what they're losing in itemized deductions, what are they losing in exemptions, are they married, do they have children, that can outweigh the increase in the standard deduction. For 2017, you'll see the tax rates go from 10 to 39.6%. You'll see in the new law starting in 2018, the tax rate is slightly lower. You do lose your exemptions, but the trade-off is, yes, your standard deduction is higher. For example, single, you go from $6,350 to $12,000. But the trade-off is you're going to lose your exemptions and you're going to be limited in some of your itemized deductions. I'll go through some of the itemized deductions. Your child's tax credit is $1,000 under the old law per child. Under the new law, it's doubling. It's $2,000 per child and $500 for non-child dependents, and there's limits. The big one, which is affecting, especially New York, where property taxes are high and high withholdings, you are, under the old law, you got all of your state and local tax withholdings plus all your real estate taxes. There was no limitation on the dollar amount. Under the new law, you are limited to $10,000 for all those taxes, so it's capped at $10,000. Your mortgage interest, under the old law, there was a phase out after the amount of the indebtedness was $1.1 million.
That included both
home equity and mortgage. So you were fine, but if the mortgage, you took the average balance of the principal indebtedness, you took the beginning and ending, and if you were over $1.1 million for the mortgage and home equity, you were limited in the amount of mortgage interest you could deduct. Under the new law, home equity debt is not deductible. So if you have a home equity line, that's not deductible. And they've also lowered the cap. So the phase out applies once you hit $750,000 of mortgage debt. Personal and casualty losses. They were allowed and they were subject to limitations. It had to be over a certain percentage of your adjusted gross income. Under the new law, they are eliminated. The only way you can take a deduction for a loss is if it is in a loss attributable to a disaster in an area that the president has declared a disaster area, declared by the President of the United States. This next one is a big one for a lot of you. Your itemized deductions, your miscellaneous itemized deductions, your unreimbursed employees' expenses, tax preparation fees, and investment expenses were allowed. Under the new law, they are not allowed. They're totally eliminated.
So that we really want to highlight that that is probably for people who receive a W-2, this is the biggest impact that's going to have on you is that unreimbursed employee businesses' expenses will no longer be permitted. So just get that through your head. Union dues, research,
Travel and entertainment.
travel, unreimbursed travel, things like that. If you were an employee, those are no longer going to be deductible.
Like
Now-
in our case, continuing ed courses wouldn't be deductible. We have to take courses to maintain our license. They are no longer deductible if we're paying for them.
That's right. So that to me is one of the biggest impacts for what happens. How does that affect you as a professional? Sorry.
Okay. And the next one, charity, that was limited to 50% of your adjusted gross income under the old law. Under the new law, it's limited to 60% of your adjusted gross income, and that's for cash donations. There's different limitations if it's non-cash donations.
I just want to point out that I've never had anyone actually reach that limit, but we just thought we would put that in for your edification.
Okay. The next slide is adjustments alimony. That was deductible under the old law. Under the new law, it is not deductible for settlements entered into after 2018. Moving expenses, which that might for your industry was an important one. That cost of travel and transportation of household goods was deductible if the move was in conjunction with the change in employment. You had a mileage requirement. It had to be a certain miles, the distance between your old and new home and your place of business. And it was a direct adjustment against your adjusted gross income. Under the new law, that is gone. That is eliminated. Under the old law, you got adjustments, educator deduction under $250 for teacher. It was deductible, so we would see that for a teacher. That was a big one with them. It was a small amount, but under the new law, it's slightly increased to $500. Next slide. In 2017, in this next one, we used to see that it was very minimal. If somebody had investment in a entity and they got a year-end statement of K1, you would see this. To the domestic production activities deduction is available to manufacturers, producers, growers.
I actually used to see that occasionally with, if I had somebody that was, I have a number of clients that are documentary filmmakers, and if so, film production was considered an activity that was, you were entitled to a Section 199 deduction. There were a lot of limits that said you had to have a certain, it was based on a percentage of net income, and you had to have a certain amount of wages that you paid. But there was a fair, I would see it under a fair number of my clients that were film producers. So the Section 199 now is repealed, and it's replaced by 199A.
199A, correct. And then Section 181, which is going to be important for you guys, film expensing election, that has been retained for 2017. In 2018, it's retained with limitations, but you cannot take the deductions until the year the film is released.
Did any of you ever take a Section 181 election where you, are any of you actually film producers? So have you taken a 181 deduction before? Yeah. So that just a general question of that. So for a lot of filmmakers, and this I would see a lot in film investment partnerships, that you have a group, an activity, a group of investors who are actually putting money up to produce a film. And at that point, they, since the film has not been released or distributed, it's just money going out. So investors wanted the immediate expense of deducting it when they put the money in. So for now, there was a question of whether or not it was retained for 2017. It was in the recent budget compromise that they had after the end of the year. So it has been retained as it originally was. But going forward, the deductions will only be available, and it won't be 100% of your investment. It will be a percentage that will decrease over time, and it will only be allowed once the film has been released.
Okay, the next section is a discussion of the new 199A deduction. I would say there's no size that fits all with this, and it is complicated. It can be tricky, so we've given you the basics and kept it to that level or higher level to more or less give you an overview of the deduction. Do you have any comments?
Yeah, so in repealing the 199A, and because the idea behind this is that the government they've lowered the C corporation tax rates to 21%. So they wanted to say, hey, we're giving a tax break to these corporations. What about people who are investors? Or what about people who are self-employed? Is it fair that they're going to continue to pay at higher rates than C corporations? So they said no. So what we're going to do is we're going to create a new deduction. First, we're going to repeal the 199, the DPAD, and we're going to create something called Qualified Business Income Deduction, QBAI. I think that's, QBA, yes. QBI or QBAI. So we'll give you a deduction that's potentially 20% of your income, but you have to meet certain rules. And there are a lot of limitations on it, some of which will probably impact you.
Okay, the general rule is that the deduction, it's up to 20% of what is called the qualified business income from pass-through entities. And there's a further income limitation of 20% of net income less net capital gain. What is a pass-through entity? It can be a sole proprietor, a single-member LLC, filing a Schedule C. It can be a partner in a partnership receiving a K-1, or an S-Corp shareholder receiving a K-1. What income qualifies? What is qualified business income? It's only income from the trade or business. Investment income is generally excluded from the calculation. And your investment income, interest, dividends, that's excluded. How is the deduction calculated? It's going to depend on, is a person a member of a specified service, trade, or business? What is the person's income level? And what is their filing status? Okay, what is a specified trade or business? Healthcare, law, accounting, actuarial services, performing arts, consulting, athletics. It's any trade or business where the principal asset is the reputation or skill of one or more employees. Example, an actor.
So I think I want to interject here that I think that would probably qualify for most of you, that if what you're doing would probably be considered a specified service, trade, or business. Now for us, we're lucky. They just named it flat out, accounting. Mm-hmm. So we know we fall under the specified trader business, service trader business. For you, it's a bit more of a gray area. What the general idea behind this is, if someone's hiring you because of your reputation, then in all probability you would be considered a service trader business. So a good example would be, do you have a company that has more than one employee? If someone hires you to perform services, is it a requirement that you go, or could you send one of your employees instead? Because if it's based strictly on your reputation, then it probably qualifies under the the principal asset is the reputation or skill of one or more employees. So if you're a specified service, trade, or business, then certain limitations apply.
The way it's calculated or the limitations. If you're single, it depends on if you're single or married filing jointly, and then it depends on your income level. So if you're single and your income is below $157,500, you would be entitled to a deduction with no wage limitation. If you're married filing jointly, if your income is below $315,000, you're entitled to a deduction with no wage limitation.
So what is the wage limitation? So the wage limitation means, are you paying W-2 wages? Okay, so do you have any employees? And if the answer is no, I don't have any employees, it doesn't matter if your income is below taxable income, by the way, and we didn't define that, but it's taxable income is below $157,000, $157,500, then you don't have to worry about it. So you can be a Schedule C, a sole proprietor, and not have any employees and not pay yourself wages, and you're still entitled to this deduction. On the other hand, if your income is above, if your taxable income is above $157,500 and you don't have employees, then it's going to be a problem. If your income is above, straight up, if your income is above $207,500, then you're not entitled to this deduction at all. So if you're in a specified service business and you're single and your income is above $207,500, no deduction, period, end of story. There's kind of a phase-out range between $157,500 and $207,500 if you're single. So that's why we said it's very important to decide whether you're in a specified service, trade, or business. Because if you are, and if your income is above $207,500, then the deduction won't apply to you.
Correct.
So that's as a single person. It's just essentially doubled if you're married filing jointly. On the other hand, if you're not in a specified service, trade, or business, then on the next page, then the income limits still sort of are the same. But basically, it's once you get above $207,500, you're subject to the wages and qualified property test, but you're entitled to a deduction if you pay wages. So to recap it, let's say, so the little decision tree is, are you in a specified service, trade, or business? If the answer is yes, if your income is below $157,500 taxable income, then you don't really need to worry about the limitations. You'll be entitled to this deduction as it's calculated. So let's just say your net Schedule C ends up being $50,000. You take 20% of that, and that's a $10,000 deduction that you would be entitled to. And that is, it falls in kind of a gray area as to where it's taken. It's taken after adjusted gross income, but before taxable income. Why is that important? Because sometimes adjusted gross income helps you figure out the deductibility of certain deductions, like, for example, your medical expenses and so on. But it's a deduction after the, before taxable income, but below adjusted gross income. So if you're between 157 and 207 or above 207, then you've got some decisions that you need to make as to whether or not it might be a good idea for you to consider a different entity. So we give on the next page an example of how the 199A deduction is calculated. So a married film director receives $200,000 of flow-through income from his S corporation, and his has taxable income of $365,000. So if you go back to the slide before, we said what's the phase-out range for someone who's married filing jointly? It's between 315 and 415. So he has to have to be able to take a deduction. He has to have some. There has to have been wages paid from the company. So in this case, there were wages. And it can be, by the way, it can be wages paid to you as an employee. It doesn't necessarily have to be wages paid to someone else. Wages paid to yourself will calculate in this will count in figuring the calculation. So the S corporation paid $100,000 of wages to him. So the Section 199A deduction will be limited to $20,000, which is calculated as follows. First, the general rule is $200,000 times 20% is the maximum deduction that the director could get, which would be $40,000, assuming no limitations at all. However, because his income is in the phase-out range between 365 and 315, between 315 and 415, so it exceeds the limit by the lower threshold by $50,000. So $50,000 divided by $100,000, the sort of the phase-out range, equals 50%. The wage limit is 50% of the wages that were paid by the S corporation, or $50,000. So then, what is the allowed deduction? It is $20,000, which is 50% times the $40,000 we calculated under the first line item. So the first line item was $200,000 times 20%, but because his income is above the level, then he's only entitled to 50% of that deduction, so he gets a $20,000 deduction. Does that make sense? It's okay, go ahead. Well, you don't lose. I won't say that you lose money. I'll say that you're not entitled to the 199A deduction. So it's you're
limited in your deduction.
That's right. So it's that, this is a new deduction. It wasn't a deduction that anyone had before. It's sort of a fictitious deduction that's designed to kind of lower your effective tax rate by giving you an extra deduction. But what they're saying is that if your income is above a certain level and you're in one of these sort of specified service activities, then you're not going to get the deduction.
Well, to put it simply, all right, so let's say person number one makes $157,500. Person number two makes $157,501. Which one pays more in taxes?
They both would be entitled to a deduction. The deduction for the one making $157,001, it suddenly the new sort of phase-out rules kind of apply to say that are you paying wages? Do you have an investment in property or so on? Those kind of come into effect. The effect on the, if it's only $1 over the threshold, the effect on it's going to be kind of negligible. But
because it's only the difference. It's not.
Yeah,
okay.
it's
right.
Yeah. So what the rules are basically saying is, oh, hey, we consider $157,500 for a single person to be a basic threshold. Mm-hmm. Below that, you don't have to worry about whether or not you're paying wages. You don't have to worry about whether or not you have an investment in property. There's another sort of sub-rule that says that if you have a significant investment in property, and I think that's really kind of designed under this rule for real estate type investments.
Right. Yes.
But for most people, it will probably be more unless you have a significant amount of equipment that you purchase for your activity. But for most people, the wage limitation will be the most important one.
Right.
But if you're making significantly more than that, then and you have been filing as a Schedule C person, the deduction may not be available to you. So it becomes the question of, would it be better for me to form a corporation and conduct my activities through the corporation rather than to just be, say, a single member LLC?
Right.
We have a few final comments on the 199A.
It's basically not a one-size-fits-all. You have to look at the particular facts and circumstances. It may be better to be a C Corp, or it may be better not to be.
It's the income limits are figured at the individual level. So if, let's say that I'm a partner in an accounting firm, then it's not the accounting firm's income, it's my share of the accounting of the income. It's my income that's going to pass through to me on
So
the K1.
if you and I were in a partnership, it would be, how does it affect you? It's your share of the income.
Yeah. So
and
the
my share for me.
157,500 is based on my income and not on the partnership's income.
Right.
I noted that the deduction is allowed after adjusted gross income, but before taxable income, and the deduction does not impact your calculation of self-employment tax.
Right.
It's just figuring your taxable income.
So you pay
Right.
self-employment tax on the total regardless of this. Okay.
That's
Right.
correct.
Right.
So we also wanted to talk about some planning opportunities to say, now, is for the 199 deduction, the question becomes, the math on this is not simple. And, as Debbie said, it's not a one-size-fits-all. It's going to be based on your individual facts and circumstances. The question becomes whether you're entitled to the deduction. And so let's say that my income falls in that gray area where I have to pay wages in order to be able to get the deduction. The question is okay, what's the cost of compliance? What would it cost me to have a corporation versus what's the deduction that I'm sort of losing? So if, for example, the cost of forming a corporation was, $1,000 after you counted the attorney or the legal service to set you up, what's it going to cost to have an annual tax return prepared if I have this corporation? What's it going to cost me to have a payroll service to pay wages and salaries? So in order to decide whether or not this is the best choice for me, it's, excuse me, you really kind of need to sit down and say, what's the deduction that I'm going to get if I become a corporation? What's the deduction I'm going to get if I'm not a corporation? If I become a corporation, how much is it going to cost me to comply with that annually, and is it worth it for me to do that?
And also the decrease in the corporate tax rate, it's down to a flat 21%. So
If you're a C corporation.
C Corp, not
So-
an S Corp, a C Corp.
Some things that I've read have suggested, maybe is there a way to sort of split your activities? And one of the
Right.
articles that I read sort of said, okay, you have a doctor, and the doctor is obviously, as a healthcare professional, falls in one of the specified services. So what if she has a couple of different activities? One is she's a doctor and she treats patients. The other is she has a weight loss clinic. So she splits off the weight loss clinic and puts that into a C corporation. Now, a C corporation has certain advantages over an S corporation in that the benefits that you pay in a C corporation are not taxable to you as an employee. So, for example, as an S corporation shareholder, if the company
Health
pays my
insurance.
health insurance, it's considered taxable income to me. Now, on the other hand, I get to deduct the health insurance, but it's still considered a benefit to me, a fringe. In a C corporation, that's not true. not only can I pay my health insurance, but I can pay all of my medical expenses through a C corporation. So perhaps I have a C corporation where I employ, I deduct my health insurance and I cover my spouse through my health insurance, and I pay all of my medical expenses through that. Well, perhaps there's a way in which I can minimize the income, make the income of the C corporation a fairly low number, and then still be entitled to the 199A deduction in my personal return, because I've managed to move some of the income out of my personal return and into this C corporation return. So another important thing is if you're an employee, is to consider talking to your employer to say, look, is there a possibility for me to lower my wages and for you to pay my unreimbursed employee business expenses? For example, Debbie just pointed out that we as accounting professionals are required to get a minimum of 40 hours of CPE per year. Well, if my employer is not picking that up now, I could go to my employer and say, you know what, lower my wages by $1,000 and pay all of my education courses. Because those expenses are deductible to the employer, but they're no longer deductible to me because I can't deduct them as a miscellaneous employee business expense and unreimbursed. Those are gone starting in 2018. So maybe I can go to my employer and work out something where I say, these are the specific expenses that I want you to reimburse. I'll lower my salary. If you'll lower my salary and reimburse those, we'll both win. You get to pay lower self-employment taxes because my wages just decreased. So it's a win-win for an employer if you can get them to agree to that. The real problem is if you're sort of a permalance where you're going to, or a freelance W-2 employee where you're going from employer to employer, it's going to be tough to get someone to agree to reimburse you for certain expenses. But if you have a stable employment where you're working with the same employer, then you should be able to negotiate that with your employer to say, hey, reimburse me for my union dues, reimburse me for my education. Those.
Like we with the state society and our license, we have to renew our license, the state society.
Yeah,
belong to that.
Sorry, but we're often employed for short-term periods by different employers, multiple employers per year. We have unions who negotiate our wages and benefits. Negotiating these types of reimbursements with studios and producers, I just frankly do not see that as a viable possibility. Does anybody else potentially see that? Or I mean, it's not just me, right?
No, I mean, realistically, you're right.
Realistically, it's a pipe dream. It sounds like.
The question for you, it's if you're going from engagement to engagement and you're,
Which is pretty much, that is the life of below the line. It is engagement to engagement.
Yeah.
There is no guarantee. If I work on a season of TV, there's no guarantee that I will necessarily work on the next season of that TV production, for example. There's no guarantee that I will necessarily work for the same UPM twice in a row. No guarantee that I will work for the same studio twice in a row. There is no continuity whereby, and also we're dealing with entities that are frankly recalcitrant and will not really want to open this discussion.
So the question becomes for you is it worth it to form your own loan-out company?
Again, most of these entities and producers typically do not want to deal with like every single below the line is going to form a loan out. As far as I understand it, they typically will not. They will only rarely deal with loan outs, and typically only for substantial kit rentals, for sound mixers and gaffers and key grips who own huge amounts of equipment that they then rent directly to the production. But the most of rank and file below the line do not do that.
Unfortunately, the short answer is you're kind of, you lose out under the new tax law. That's the bottom line on it. Ann?
The unions really need to take a good look at this. And although I don't think it's a good idea to lower wages in a contract, it is a possibility that they could lower the wages and pay not only the union dues and the unreimbursed business expenses, but also the agent's fees, which is huge for some people that they will lose. And I think it's important for the rank and file to discuss with their union presidents to look into these contracts and see if it can be done.
Yeah, in something that has become very popular for employers in general, and Debbie and I used to work together at the same firm, and she still works at this firm, is an outside employment organization. They're called professional employer organizations, PEOs. And, you know, I mean, it's the question, so the PEO is the employer of record.
Correct.
And not the particular firm we worked for.
Right, like my W-2 and paycheck comes from the outside firm. It's not under Edelman, Katz and Mont. It would be the outside firm. So all the HR, the benefits, it is all outsourced to them.
So it becomes a question of maybe the unions could think of forming or working with someone to form outside employer organizations so that the paying the agents' commissions or paying the union dues or paying certain expenses can go through the PEO. You know, there's not a simple answer to this question, and it's for people that fall into the, you know, below the line category. It's, you know, just like accountants, you're screwed under the new tax law. So.
Would you consider entertainment partners to be that type of organization? Because they are outside payroll companies that most employers use.
Yes, yes, they are, and the reason, I mean, they are a professional employment organization. They do more than that, though, and they're designed to do things like monitor residuals that are due to talent or different people within the production. So, you know, maybe the question is whether or not they can do not just for talent and above the line people, but also do something for the below the line people. You know, maybe it's getting the unions to approach entertainment partners, you know, or the other CAPs or any of the other organizations to say, look, you're doing this for these people, can't you do it for these?
My question is sort of related to what that woman was saying, is that, you know, when I go to file unemployment or something like that, my employer of record is the payroll company. I think it becomes complicated to start to ask the union to reduce wages or things like that, because that affects my pension, health care, all of those things. Is it something that can be done through the payroll company, how that's filed? And I see a good number of familiar faces here. I would guess most people here are below the line and dealing with that and not as much agents' fees. I don't know if I'm wrong there, I'm sorry. So is it something that can be addressed through the payroll companies? Because I know, you know, as this gentleman said, I've been on a show as a gaffer for a while, and all of my equipment rental goes through the rental house. It does not go through the production company. And production companies, unless you own, as he said, the whole truck, the whole kit, are only going to deal with you as an employee and not as a loan-out corporation.
I don't have a simple answer, and it's you know, I think that Ann has a great thought in thinking that you need to talk to the unions about, look, we're going to be losing all of these deductions. Can you help us come up with some sort of solution, a way in which we can not lose under the new tax law that you know, we for example are not going to be able to deduct this, we're not going to be able to deduct that. You know, how are we going to adjust it in such a way that we're not losing out so much under the new tax law?
That may be a reasonable solution as contracts come up for renegotiation, but maybe, I don't know when the next contract negotiation is for 52, but I know a lot of those things come up at the same time, and I do not believe it's next year. Someone could correct me on that.
Hi again. Let's talk Schedule C for a moment.
Yes.
So, can you write off union dues as a professional subscription on your Schedule
Yes.
C?
Yes.
And
Yes.
then for kit rentals, you can still funnel those to your Schedule C and write off of the kit rentals.
Yes.
Okay, that hasn't changed. The other question was, let's see. The 1099 deductions. So I also have a partnership. So we produce commercials. Now, we just do the production of the commercials. Can I still write off all the cost of goods sold and expenses related to that in that year, even if it premieres the next year? Or is that considered?
Wait, I'm not clear. Ask your question again, sorry.
Sorry, I'm not an agency, I'm a production company.
Yes.
So agency hires us, we produce, we production services as we call it, and then they essentially buy it off of us. They take it. We can still write off all the cost of goods sold.
Sure. You're a cash basis taxpayer, and so you deduct expenses when you incur them. So yeah, and things that it doesn't affect, if you're a Schedule C or a partner in a partnership or, an S corporation shareholder, it doesn't impact in any way your ability to deduct expenses associated with your trade or business. What the tax law has said instead is just W-2 employees, your unreimbursed expenses are gone. That's just, but any other type of business, including Schedule C,
Right.
partnership,
Correct, that has not changed.
All right, so that's still business as normal.
Right.
yes.
Okay.
I will say with Schedule C, I have gone through a number of audits, and when we say document with receipts, they will ask for it in a Schedule C audit. And and I've had agents say, if you do not have the receipt, they will disallow the expense. They do ask for the travel log, and that's like one of the first things they ask for.
Right, no, I put most things through the partnership anyway, but.
Yeah, but they are with the receipts. And we've have to submit the receipts, and they will say, okay, what was this meeting? Did you note on who it was, and what was the business purpose?
And it has to be physical copies, they don't take digital?
Well, no, they'll take digital. I mean, if you scan, at this point, if you scan your receipts and retain copies, a scan is fine.
Yeah.
But it's you need some record of it.
Yes.
And I'll say that having the American Express statement by itself without the underlying receipt is not adequate.
No.
So if, unless it's something like a taxi or an MTA,
Right.
although theoretically you're supposed to be able to say what, the taxi was business related because
Right.
I had to go home late at night. But anything else that has an underlying receipt you need to have.
Right, and we had a taxpayer in the office who was an actor, and she had all her credit card statements, her Amex, and could document it, and we had to go back to her and say, we actually need the receipts. The statements by itself with the description of the expense,
What's
it
the
was
limit
not
there?
good enough.
It's just essentially for meals and entertainment is where they're gonna hit the hardest.
Well, no, it's in my mind, it's clear if you've got like a restaurant, that, and it says on the thing that it's a restaurant,
Right.
then what you need to be able to say is who it was with. In other things, it's, say for example, I buy something at Best Buy. Well, I can buy a lot of things at Best Buy. It might be a TV for my house, or it could be a piece of equipment, or it could be, a computer. If you don't have the underlying receipt
For
to say-
that, then you got a problem.
yeah,
Okay.
yeah,
Yeah.
but it's something like
Yeah.
meals. You need to be able
Yes.
to, it's clear on the statement that it's a meal, but you need to be able to document who the meal was with.
Yes.
Okay.
Yeah.
Yes.
So then, if you had a credit card receipt that wasn't itemized, that would also be invalid?
Give me an example. What do you mean? Sorry.
So if I had the physical receipt for something, but it was just a credit card receipt with the signature and it wasn't an itemized receipt, that would also be invalid source?
Probably. I mean, it's if the IRS can't tell what you're buying, then they're going to have an issue with it. So it's try to get something that documents what it is that you purchased. I just had an audit with a client, and by the way, I'll say that New York State is becoming much more aggressive in their auditing than just the IRS.
Yes.
I had a client at the end of the year who got a notice that said, basically, send us all of the documentation for all of your itemized deductions from New York State. Otherwise, we're just going to disallow your itemized deductions. So, you know, we had, for her, she had purchased a computer, and we couldn't find the detailed computer invoice. We clearly had the statement, you know, the Lenovo that, you know, she purchased a laptop. We had the bill of lading. So it was clear that, you know, a computer was shipped, and we could match it up to the statement. So it's just, you know, you want to be able to document it in some way, but if there's no itemization whatsoever, then it's sort of like, how do we know what this is?
So I know we're starting to get into the Q&A.
Yes.
We've kind of rolled into that.
Sorry.
But if there's anything else you guys want to say on this portion, we'll take a break and then jump into the Q&A, or else we'll go for hours.
Yeah.
So again, guys, thank you guys so much for doing this.
You're welcome.
We're going to take about a 10-minute break, get some coffee. I know this is stressful and it's not hitting us the right way. We'll get through this together. Thank you, guys.